underweight at the expense of being overweight cash, and high yield bonds are a little bit overweight because of the prospect of falling rates, which makes bonds go up. So any comments on the positioning? No. So we go on to the performance on page 4. This is as of June 30th. The latest quarter is 1.61%. Equities return 1.7. Why so low? April was a bad month. The stock market pulled back 4% because inflation was bad, and it caused the Fed to talk about fewer interest rate cuts. May came along and went up about 5. So between April and May, the market pretty much broke even. And June, large cap stocks did well, but small cap and mid cap did poorly. They were down 1%. So you add those 3 months together and you end up with 1.71. Also, the convertible bonds are in that 1.7% number because we count convertible bonds as stocks because they're a hybrid. Taxable bonds, which are the high yield bonds, return 1.93% because the fact that they tend to behave like stocks, high yield bonds do. So because stocks in general went up a little bit in the second quarter, high yield bonds followed because they have an equity-like component to them. And then cash return 0.42. Year to date, which is the fiscal year to date number, the account is up 20.66%. This is good news because we're making up lost ground that we lost in 2022. So from September all the way through June, and the numbers are still out for July, August, and September, 20.66, and that's 3/4 of the way through the fiscal year. That's a good number. That's the equities. That's not the bonds. And I'll let Burgess Chambers give you the total return in a minute. If you look back 5 years, the equity portion was 10.48% per year. That's outstanding. It's rare that you see equities give you 10.48, and that's a lot of that is technology stocks. Tech stocks make up over 30% of the S&P 500 index. So it's technology stocks that are driving it. If you pulled out the 10 largest companies in the S&P 500, the total return of the stock market would be much, much lower. The top 10 largest are driving it. The other 490 are not. They're okay. They're up this year, but not. We would not be up nearly as much if it wasn't for Google, NVIDIA, Microsoft, Eli Lilly, maybe Tesla, JP Morgan, even Walmart. So having said that, any questions on the performance? Nope. And then page 5 is just simply the July numbers that I put in there for information. And you can see the latest quarter jumped. Instead of being 1.6, the latest quarter is 8.28. So the market recovered some in July. Small cap and mid cap jumped up, and equities over the last 3 months ending July is 9.45. What a difference 1 month can make. So having said that, if we turn over to page 7, just a snapshot of the equities, you can see where the income that it throws off is $209,718. It says 75% stocks, but it's not that high because this is just the stock portion. If you put in Sawgrass, the equities are right at 70. I can go up to 75. I can't go over that by the policy. So in July, I did sell 3% of equities because we did hit 75. I sold 3% of equities and I gave it to Sawgrass. So that's part of what I do is keep the fund in line with the policy. Page 8 is just a snapshot of the funds that we use. They're index funds. They're low cost, if not no cost funds. Page 9 is the 2 more of the index funds. And then page 10 is a snapshot of the Sawgrass account, which is because we are the custodian, I show this. So just to let you know that your assets are held not at Capital City Bank. It's against the law for us to hold them. By law, it has to be an outside custodian. So they're held at Reliance. So we are the custodian of the assets, and that's the custodian's report. Any questions? That concludes my comments.
Any questions?
You can't argue with results.
Yeah, good results. It's been a good year.
Thank you. Do we have a motion to approve?
Some of we approve capital city.
Second.
Motion is second. All in favor? Aye.
Aye.
Any opposition? Thank you. On to the BCA report, Burgess Chambers.
Good afternoon.
Good afternoon.
Mitchell Brennan with BCA here in for Burgess. And so I'd like to go over just a quick handout. It's got a little bit of data since quarter end, but really goes over the trend of the market. And so we'll start on page 2 of that. Chart that looks like this right here. And so really to start 2024, it was a continuation of 2023 where we saw Dwayne's point, really very top heavy stock market where the Magnificent Seven is what they're titled. So that's NVIDIA, Meta, which is Facebook's parent company, Microsoft, Amazon, Apple, Alphabet, Google's parent company, and Tesla. Those 7 names have continued to lead markets higher. So for the first 6 months of the year, they were the primary source of returns for the market. This chart on the left-hand side is actually through the end of July, which you can see that green line, that sharp downturn. So after quarter end, we started to see a little bit of a reversal where those 7 names took a back seat and pulled back anywhere from 10 to 30% in the month of July. And some areas that really haven't participated in the market rally for the past couple of years, small cap, large cap value, started to outperform in July. But through the end of July, you can see year to date, those 7 names are up on average 29%, contributing over 50% of the total return of the S&P 500. So the other 493 companies on average up just 7%. If you go to the next page, to my point, page 3, here, these are the returns quarter to date through Friday. And so you'll see what I've highlighted in green down the quarter to date column. So that's July 1 through Friday. The Russell 2000, which is the index for small caps, and the Russell 1000 value, which is the index for large cap value. Pretty good so far quarter to date. Compare that to what's highlighted in gray right between them, the Russell 1000 growth, that's large cap growth, up just 1% through Friday quarter to date. And if you go all the way to the far right column, you can see what I mentioned as far as not really participating or participating to the same extent as large cap growth. On a 3-year basis, small cap up just shy of 5% annually for the past 3 years. That was actually at quarter end, so at June 30, that was actually a negative number. And then Russell 1000 value, large cap value, from an absolute standpoint, 22.5% is great returns. But look just above that, you'll see the Russell 1000 growth, large cap growth, up 32% annualized. So nearly 10% outperformance on an annual basis over the past 3 years. Again, contributed almost entirely to those large cap tech, communications growth names in the Magnificent Seven. And so outside of that, what's moved markets has really been inflation, and then inflation has indicated where the Fed will go with interest rates. So on the next page, page 4, this is a chart showing the trend of inflation going back to early 2021 through June of 2024. And so you'll see the trend, the peak in June of 22 at just over 9%, subsequently falling to June of 23 to 3%. And then really for the past year, been bouncing between that 3 and 4% range. We finished June of 24 back down at 3%. And our house view has been, the Fed is not really going to be in a position to start cutting rates until we break through that 3% threshold. Their target is still 2%. Fortunately, we just got the July numbers in, and CPI year over year was 2.9. So we finally broke through, and now the probability for the Fed cutting rates in September is as close to 100% as you can get. Now the real talk, if you go to the next page, is will we see just a 0.25% cut? Will we see a 50%, 50 basis points, so 0.5% cut before the end of the year? And so the Fed's expectation is just 1 cut currently. The market expects potentially 2 before the end of the year. And then if you go to the next page, this is just a closer snapshot of those expectations. You can see 1 rate cut this year for the Fed, that's the blue dotted line, and then 4 rate cuts in 25 and 26. bringing rates from over 5% back down to that 3% range over the next 2 years. Now, the market's a little more aggressive quicker, gets to the same point in 2026, right around 3%. But again, the market's expecting 2 to 3 cuts this year before the end of the year, and then an additional 4 cuts next year. So our view is the Fed is going to be slow and methodical unless we see a potential recession or severe economic crisis that spurs them to act more aggressively and cut rates quicker. But so far, earnings have been strong, consumer spending has been strong. The labor market, despite some mixed reports recently, has been strong. And so with that, it seems like we may be in line for a soft landing where we avoid a recession or certainly a deep recession. On the next page, speaking of jobs reports on page 7, this is one signal indicator for markets that's predicted the last 12 recessions going back to 1947. It's called the SOM rule. And it's a lot of data here, but essentially all it's showing is the SOM rule gets triggered when there's an acceleration in the unemployment rate. So when the average of the last 3 months employment rate gets 0.5% above the lowest point over the past year, it triggers the SOM rule. And again, just indicates that there's an acceleration in unemployment, which historically has predicted a recession on the horizon. Now, I'll caveat this, you know, that 12 for 12 sounds great. I played baseball. I would have loved to go 12 for 12. But we have other signals like the inverted yield curve that have that same track record. And we've been in an inverted yield curve since July of 22 and have not been in a recession. So the famous saying is, you know, it's different this time. So far, that's been the case, but you know, the more red flags that get raised in predicting an oncoming recession, the more worrisome we get. And so that's why obviously the conservative positioning from Dwayne, as markets get higher and higher, it's easier for them to come back down. And so with that being said, again, we're still seeing very strong consumer expenditures, very strong growth. Company earnings continue to be strong. Unemployment is at 4.3%. The Fed's mandate for full employment says it can tick up all the way up to 5%. So we're still under that threshold. So again, in terms of that data, still a very strong labor market that we're currently in. And then lastly, on page 8, couldn't go without talking about obviously the election coming up and how that impacts markets. So historically, what we've seen is going into an election, there's volatility because of the uncertainty. And then post-election, with that certainty in place, a new administration or current administration continuing, that certainty typically leads to markets going higher. So going back to the mid-40s, every presidential election, on average, the market is up close to 10% for the following year after the election. Now, the views of individuals and voters may change. This chart here is very interesting. It shows how Republicans and Democrats view the economy during different administrations. And to no surprise here, when a Republican's in office, Republicans tend to think the economy is better than Democrats do, and vice versa. So I don't expect that to change. But from a historical standpoint, it really hasn't mattered who's been in power in terms of how markets perform. And so if you look at the past 3 administrations, the Biden, Trump, and Obama administrations, over their tenures, on average, low to mid double-digit returns. The outlier there is obviously the Bush administration, a negative return over that tenure, but keep in mind that incorporates 9/11 as well as the great financial crisis in 2008. So looking at those 2 outlier events, put those aside, historically, you know, no matter which party you're in, you want to see a strong economy and a strong market. And so we hope that whichever administration goes into place, they'll enact legislation and a plan to keep the market strong and the economy buzzing along. So with that, I'll conclude that handout and jump to our report, unless you have any questions or anything you want to discuss about that. So just briefly.
I don't have anything.
Okay, thank you. Go ahead.
Yeah.
Yeah.
Yeah, so briefly on page 4 of our report, the news that you've been waiting for, another fantastic quarter. This is probably one of the best quarters I've seen for our clients, up 184,000, which was the equivalent of 1.5% return, ahead of your strategic model, which is at 1.4%, and ranked in the top 26 percentile of other public pension funds across the country. led by your large cap index fund, up 4.3%, followed by high yield, which is up 1.4%, and then your global infrastructure manager up 1.3%. The next bullet there, fiscal year to date, so 3/4 of the way through your fiscal year, 1.9 million in investment gains, good for a 16.6% return. Did trail the benchmark there. Some of the active managers and convertibles underperformed their benchmarks. But besides that, ranked in the top 16th percentile of other public pension funds across the country. On a 1-year basis, 1.4 million in investment gains, good for an 11.9% return. And the best performers over the past 12 months, again, large cap leading the way, up nearly 25%, followed by mid cap up nearly 17%. And then your international manager, American Funds Euro Pacific, up just over 11%. On a 5-year basis, 4.2 million in investment gains, good for a 7.3% return annualized, ahead of your benchmark. And then for the past decade, 7.1 million in investment gains, good for a 6.2% return on an annual basis. All right, if we flip to page 7, I'll just highlight here, these are some of the numbers I went over. But since quarter end, so pulled some current market values through yesterday. And it looks like the plan, and I'm not sure if this includes state monies being deposited, but since the end of the quarter, you finished June 30 at just over 13 million. You're now at 13,528,000. So roughly 450,000 increase in the account between investment gains and deposits. So continuing a very strong fiscal year. Hopefully we can keep that through the end of August and September. September typically tends to be a pretty volatile month, but hopefully we can capture that in your fiscal year to date return, remain in that 16 to 17% and recover, most of, if not all of the losses we experienced. And then with that, flipping over to page 11, again, these are all the individual securities and how they perform. At the very top, your total fund, and what you see in parentheses is the ranking versus other public pension funds across the country. And so again, as of recently for the past year and more current, very strong performance, especially coming out of 2022. So with that, we don't have any concerns or issues with any of the investments or the asset allocation. Our one consideration is, as rates start to come down, we may want to start to rebalance some of that cash back into bonds and take advantage of that bond rally. But to Dwayne's point, right now you're getting over 5% in cash, so it's really a pseudo bond having that that kind of yield in cash right now. But should we start to see the Fed cutting rates, we will start to generate pretty strong returns in bonds, and so we can take advantage of rebalancing into bonds periodically, taking advantage of the high interest rates right now and lower interest rates, increasing the market value of those bonds. So that's the one consideration that we have out there. And other than that, the numbers speak for themselves. Dwayne's done a fantastic job, so very happy with the performance and closing out hopefully a very strong fiscal year. With that, I've said a lot, so I'll conclude my report and just open it up to anything the board would like to talk about or ask questions.
Mr. Norwood, any questions?
None for me.
Okay. Yes, Mr. Newcomb. Okay, great, thank you. Do we have a motion to approve the report as presented?
Motion to accept the BCA report as presented.
Second.
Motion is second, all in favor? Aye. Any opposition? Thank you. On to Klausner, Kaufman, Jensen, Levinson, Anna Klausner Parish.
Hi, everybody. I have nothing to report on my legal end. Just wanted to make a note that our office will be at the Division of Retirement that is happening in November in Daytona. I'm sure Kyle will talk to you about those dates. So hopefully we'll see some of you there if you're able to attend, and I'm happy to answer any questions if there are any.
I don't think anybody has any questions. Thank you.
Thank you.
Resource Centers, Kyle Tintle.
Yes, welcome to all the trustees, and it's so nice to meet the other service providers. I'm pleased to be here. Unfortunately, I didn't pull out of your packets the meeting dates for the schedule. I'm gonna have this checked with the city first before I publish it, and I'll bring it back the next meeting for us. So our next meeting is in December, so I will bring that back at that time. I do have in the packet the premium tax distribution from this year versus last year. Last year, in 2022, it was 99,810.94. This year went up to 113,280.65. So I was glad to see that went up for you. The conference list we put in your packets on both sides. These are some regional ones, the Georgia one, but I do have the handout for the 53rd Annual Police and Firefighters Conference in Daytona in November. I have the itinerary if anyone is interested in it. I can hand them out after the meeting. Our finance group in my company puts together these unaudited fiduciary net positions, the income and balance statements. And I wanted to show you how they put them in the packet so you get familiar with seeing it. This is up to the June 30th, ending June 30th. So that is in there just for your information. Nothing has to be approved. If you have any questions on any of the numbers, please let me know. The conference attendance is a little different. In the past, the city had a credit card to pay for the rooms. We don't have a credit card to pay for the rooms. We ask that you hold the room with your own credit card. We will pay it with the tax-free, tax-exempt certificate, and the hotel will all be prepaid by the time you get there. So there are no issues. They just hold it for incidentals, but everything is prepaid in advance. There's a travel advance available for you if you like. If not, you can turn in the paperwork after the conference and we will reimburse you for that. So if anyone's interested, if you let me know either by email, I have a firefighter who's attending the conference.
I'm actually looking at the November one since it's so close in Daytona.
Yes, and that's going to be a good one. Close for say they are going to be there.
Any questions?
Any other questions? Because I have the hand up. Okay. Thank you.
I do know.
You're right.
I know you're pulling the dates for the meetings,
Yes.
but I do just want to throw this out there. I am in the drop and in my last year of drop.
Oh, okay.
So the May 27th meeting will be my absolute last. So whatever we need to do to start getting, whether I need to post something, whether we need to do an election or however we have to do that, I need to know how to go forward with that as soon as possible.
And that's all.
Thank you. Any questions, Mr. Hill? Thank you. Quarterly expenditure.
You have the expenditures in your packet and I will.
We have a motion to approve the quarterly expenditures.
A motion we accept the quarterly expenditures as provided.
Second.
We have a motion and a double second, a second. All in favor? Aye. Any opposition? Thank you. I'm going to open the floor to public comments. Is there anybody here for public comments? Seeing none, we'll close public comments. Are the business meeting dates that's coming in the near future in December as Ms.
Just
Tintle?
one additional item. I
Okay.
know everyone heard. 26th of September, we're going to have a meet free for retirees and current employees over in the annex. And the invitation coming out. So talk to some people and meet some people from my company that will be there and we'll hear for questions for retirees and current employees. If anyone's interested in getting some information, on our company or the pension itself.
Thank you. Any other comments, questions? Okay, with that, do we have a motion to
So
adjourn?
moved. We adjourn.
Thank you, everyone.
Thank you.
Aye.